Repayment versus interest-only mortgage. What's the difference and why does it matter? If you don't know, you could be throwing money away. Let's fix that. Let's start with some simple mortgage maths. And don't worry, I know hearing maths could have scared some of you already, but fear not. There are calculators online and we are going to be using one of them to run through this example. So let's say you are borrowing £200,000 for a property over the period of 25 years at a fixed interest of 5%. Now let's see how both type of mortgages differ in terms of numbers. So right here we are using the basic online mortgage calculator. We have put in the values of £200,000 as our debt and over a period of 25 years for a fixed interest rate of 5%. Right here we have also picked our mortgage option, which is currently set at repayment option, and over to the right we can see our results. Now we will note that based on this calculation, we are meant to be paying a sum of £1,170 per month. And what I like about this calculator is it also gives you the graph. And if you look at the graph, it kind of gives you a burn down chart of how much you'll be owing per time over the period of the 25 years. And we'll come back to look at this graph in more details. Now let's go to the second option, which is interest only. So over here, if I pick interest only option, we go to the bottom, click calculate. Now we see that our monthly payment has changed. Now we are to be paying £834 per month. And if you look at the graph, it is just a linear flat line, meaning at every single point within the 25 years that we are taking this mortgage, we are still going to be owing the initial debt, which is £200,000. Key difference explained. So we can see that with a repayment mortgage, every month a portion of your payment reduces your loan balance. But in the early years, most of that payment goes towards the interest. In fact, banks structure it so that they get paid first, meaning the real progress on the capital doesn't kick in until years down the line. Now, if we go back to the example we made, you will notice, let's go back to repayment, calculate. You will notice, look at the graph. Now, if you inspect this graph properly, you can see that at the early years, say around the fourth year of this mortgage, you still owe about 182,000. That's barely nothing off your initial debt. And if you go way down, let's go to like year 10, you're still owing about 148,000, meaning just barely 52,000 has been taken off your mortgage. That's in the first 10 years. So what this means is that when you're making your monthly payment, a large chunk of it actually goes to your interest. Why? You just have a little going into your capital. In contrast, with an interest-only mortgage, you are not paying off any capital during the mortgage term. At the end of the 25 years period, you still owe the full £200,000. And you might ask me, why would you want to do that? Don't worry, we'll get to that shortly. Why repayment mortgages are for residential buyers? Repayment mortgages are typically required for residential properties, especially if you are buying a home to live in. Why? Because the guarantee to the bank is based on your income. Yes, your income. So what they do is they assess your salary and other sources of income that you might have, just to make sure you can consistently pay over the period of the mortgage. Now, banks want that security. Also, the older you are and the closer you are to retirement, the more risky you are to a lender. You will notice that when you want to get a mortgage, they always ask you about your age, and that's because they are always looking for that sweet spot. I mean, you agree with me, it will be risky giving a 50-year-old person a 30-year mortgage. So quick advice to the young chaps out there: make A while the sun shines. Now let's talk about interest-only mortgage. Why interest-only is perfect for property investors. Now, if you are buying an investment property, an interest-only mortgage is often the preferred and smarter option. And here's why. Number one, you have low monthly payments. And low monthly payments means more cash flow for you. So you're only paying interest, your monthly mortgage payments are lower. That means more profits for you each month, which you can easily take and reinvest into your next property. And this will definitely help you scale faster. Number two, stress test is against rent. The bank or lender doesn't really care about your personal income when it comes to an investment property. The main thing they are interested in is that the monthly rent from the property can comfortably cover the monthly mortgage payments. So if the numbers stack up, you're good. So for example, if your monthly mortgage payment was £500, they will confirm the monthly rent from that property is more than £500 and with a clear margin. This is usually done by using a safe rate to do the calculation, and they usually add a buffer of 25% just to compensate for any future changes. And that's how they stress test the property. Once you have a clear margin and it's obvious that from the rent you're going to be making more than the monthly mortgage and in excess, you're good to go. Number three, inflation works in your favor. So, quick one, let's go back to the calculator we used earlier. Now, if we go back and look at our results for repayment mortgage, you will notice that the total payment we have to make at the end of the 25-year period is in excess of £350,000. However, if it was interest only mortgage, the total payment you have to make is about £450,000. Now you would be like, oh, I'm paying more at the end of the day with interest only. Why not just go for repayment mortgage? But here's the thing: inflation. Over 25 years, the value of money changes. What £100 can buy today will likely be worth maybe £50 in the future. So that 200,000 loan you owe won't feel like £200,000 in 25 years. So don't let the total amount of money you have to repay with this based on this calculator scare you, because at that point in time, trust me, the value or the worth of that money won't be the same. So at the end of the 25 years, you have different options. You could pay it off in full and own the property. This you noting that in 25 years, the property would also have significantly appreciated by then. Number two, you could sell the property and make great profit. A property of 200k today could be worth as much as 400k in the next 25-30 years. And you selling that, that's a beautiful profit you're making on that. And number three, you could refinance the property again at the end of the 25 years from the money you get from refinancing. So let's go back to the example. Let's say the property is now worth 400k. When you refinance, you definitely have more than enough to pay the amount you owe, which is the 200,000. You pay off your debt and you still have excess left to invest or reinvest in other assets. So to wrap this up, if you're buying a home to live in, repayment is usually the way and often the only option available. But if you are investing in property to build wealth and cash flow, then interest only gives you the flexibility, the profit, and the long-term advantage to scale up your portfolio. So tell me, what type of mortgage are you looking at right now and why? Drop it in the comments below. And if you found this breakdown helpful, make sure to like and subscribe for more reward property strategies. See you in the next one.